The Ozone IPO shares jumped by 40% immediately upon the launch, while McAfee dropped by 7%. Snowflake, BigCommerce, Berkeley Lights almost triple the investors' investments. But Ligi, IDTX Therapeutics, and Phoenix Tree Holdings left the investors with 75% losses. How can we better understand the IPO market and what critical factors must we pay attention to? We're going to take a look today. Hi everybody, this is Oleg Ivanov with you on the Ivanov Invest channel, looking at Trendsetters. In here we discuss emerging trends that are already changing our life or may soon begin to seriously influence it. Subscribe to the channel, click on the bell so you don't miss out on the upcoming episodes. And today we will discuss the most high-profile and striking upcoming international IPOs. Be sure to watch this video to the end, where I will reveal the most and the least successful IPO deals of 2020. And most importantly, I'll give you a simple tool how to calculate the real return on investments on your IPO literally on your mobile phone. And believe me, it is vastly different from what we see in the press releases. So here we go. So investing in an IPO is usually a big and loud event. The IPO is often presented as such a long-awaited ending for everybody. Investors who have been waiting for their profits for so long, founders who will finally join the ranks of multimillionaires or even billionaires and update the global Forbes rankings. At the same time, how can an ordinary investor with a small amount of money take part in this celebration of life? And the most important thing is to know what to watch out for. First of all, let's figure out why IPO investments are so attractive. And here are some of the obvious things. First of all, you can take part even with a small amount, just with several $100s. There's generally a relatively quick return on investments, usually within 3 to 6 months between the amount invested and when you can take your returns back. And finally, some relative transparency of transactions. So you can choose which companies to enter and which not. If you don't like SpaceX or Airbnb, simply don't buy these shares. And of course, the status and prestige, even the feeling of some coolness from being involved with the most famous companies in the world. You must agree that it's so nice at gathering in a bar or a dinner, even with parents or friends, to say something like, "I've decided to support the good old Elon Musk, let him play with his funny space rockets." But as always happens, IPOs do not always provide amazing results with pleasant percentages of profitability, but also some painful and sometimes spectacular failures with massive losses. As it goes with any investment kind, there are subtle and hidden nuances that even after years and years of scrupulous work on precise selection of projects with meticulous earning figures, increasing your earnings step by step with hard work and patience, all of this can be destroyed in an instant.
This is the worst day of my life.
The worst day of your life so far.
Let's go through the 4 main areas that you should definitely pay attention to in any IPO deal, starting with the simple and moving to the more complex areas. And at the end of this video, the promised simple calculation of the IPO profitability, which will open the eyes of the many, as I'm pretty sure. So starting with the obvious, lockups. A lockup is a period of time when you're forced to keep your amount of money inside an investment without the ability to withdraw it. Traditionally, most IPO deals will limit you to 3 months until you can sell your stock and get your earnings back. It is also important to remember that the preparation and entry into the trade itself will also take time, from several weeks to a month, and sometimes more. The bottom line is that each cycle of this trade between entering and exiting is often starts with 4 months and may stretch out to half a year and more. So by the time you are technically able to sell your shares, the price of your shares can drop dramatically. The second point to pay attention to is commissions. The people and companies that arrange deals for you, including IPOs of course, make money from this job. Fees can be completely different, from the minimum banking for like depositing an amount and withdrawing it, and brokerage commissions as a percentage of shares sold at the market price, to commissions for organizing the transaction, especially if you made a decision to make a large deal through a separate legal entity set up specifically for yourself, which will, for example, allow you to allocate a larger amount to the selected IPO. And finally, up to the commissions for success or success fees, when the organizer will take 20 to 30% or more for the increased amount of whatever you invested in this IPO. So up to a third of income received on each transaction may simply not reach the investor. So make sure you watch those percentages, guys. And in the third place, we have an often overlooked factor which we will call the transparent legal framework. This is one of the oldest tricks from the books. You look at the expensive offices in skyscrapers, crowds of young and beautiful, well-dressed employees, impressive stacks of documents for signing with small print on both sides of the sheets, folders, pens, gift bags with logos, TVs with Bloomberg turned on with stock tickers running across the screen, of course. From Bernie Madoff and MMM of Mavrodi to fundamental brokerage firms with highly intertwined legal structures, it is important to always figure out where exactly your money is going, what will you own ultimately. Let's not point the fingers, but in a number of brokerage companies you will never get a complete legal framework that guarantees you that you are the owner of the exact shares that you paid for. Can you transfer those shares from your account within this broker to, for example, your personal Interactive Broker account? Can you get scans of documents along the entire chain of the transactions to the very last underwriter in New York who distributes such shares to their clients? Why is this important? Simply because you need legal documents not at the moment when the whole structure works, but when irregular events occur and the mechanism stops functioning. Who will you go to? From whom and how will you take your money? What instruments of influence do you have in your hands, especially when large sums of money are at stake? And finally, let's get down to the most specific IPO question, which is percentage of order execution. With any broker who will organize investments for you in this or that IPO deal, you will face a similar limitation. In the vast majority of cases, any of your desired investment amounts will be cut, and you will learn about this only after the deal is done. In other words, let's say you send $1,000 to invest in an IPO of Airbnb, but as a result the broker will be capable of allocating only $200 of what you've sent to the deal, which you will learn about after you have sent the funds, and the remaining $800 is left hanging idle in your account. Needless to say, there are two more very obvious correlations, such as the more successful the project is, the lower the percentage of order execution you will have. It is not uncommon when brokers are forced to reduce the size of your entry to an IPO even to a fraction below 1%. Can you imagine this? Or more frequently to 20 or 30% of the requested amount. And also, such market restrictions often lead to the fact that brokers themselves introduce internal rules. And for example, their old and larger clients are offered larger allocations than newer or smaller clients. Now, check out the actual run-up in real order execution rates this year for selected IPOs. Upstart Holdings, 0.5% to 7%. C3AI, from 0.5% to 5.2%. Kinnate Biopharma, from 0.5% to 2.5%. Airbnb, from 0.5% to 49.1%. Ozon, from 0.5% to 63.2%. Why is this so important? Let me just highlight these two very important criteria. First and foremost, few people actually calculate the real profitability of all the investments in the portfolio. Let's take an example. If 80% of your amount is idle after a confirmed entry to an IPO for just 20%, then the profitability of this particular IPO should be calculated on the entire amount of the money on your brokerage account and not just the amount invested in this one IPO. Let's play with numbers a bit. Let's say you transferred $1,000 to a broker and, as an example, you decided to participate in the IPO of Ozone. Let's say that only 20% of your requested amount was allocated and, as a result, $200 went to this Ozone IPO. It took you several weeks to complete all the nuances of the deal, and then after 3 months of the so-called lockup, you get your 41% income on the invested $200, which is $82. 41% to $1.
There it is! It's beautiful!
This is a great result, isn't it? Not so fast, guys. Do not forget that at this time you're keeping a whole $1,000 on your brokerage account, not just $200 which went to Ozone. So your $82 income from the Ozone IPO is only 8.2 on your total $1,000 investment. Once again, 8.2% real return versus a beautiful figure of 41%. Quite a difference, don't you think? But hold on a second, you might say. After all, I can transfer the remaining $800 into other IPOs while I'm waiting for the Ozone's returns for these 3 months, right? And you will be right, but only partially. Because first of all, it is quite important to understand that if you are lucky to pick only the most successful IPOs, which is in reality very rarely happens, all your allocations will be cut. Thus, you're unlikely to be able to place the entire amount, which means that you will constantly have some part of your money sitting idle on your brokerage account. This leads to my second argument, that not all IPOs are successful. There are unsuccessful IPOs where you lose money. And with such unsuccessful cases, the IPO practice that you have become accustomed to change completely. Your investment allocation, which you will send to the deal, will not be cut and you will be filled in full, which means that you will take a loss on such an IPO on your full amount. Now let's go over the numbers again so that we all understand what we're talking about. There will be a lot of numbers now, so please focus on these as they will reveal a very fundamental aspect which is crucial for IPO deals. So once again, you have $1,000 and it is still on the broker's account, and your $200 is allocated to Ozone, for which you pray and expect your 41% income in 3 months. Next, you apply for the participation in the next series of IPOs, say Airbnb, Upstart, Certara, and in each of these your allocations are cut again, say by a level of 20% from each of the requests that you made. So all in all, you will be able to invest only up to 20% in Airbnb, but not from the $1,000 now, but from the $800 which is left after your Ozone investment, which is now $160. Certara will end up receiving $128 from you and Upstart $102. And after all these investments, you will still have $410 of unused capital in your account. The returns of these new 3 projects are still very encouraging, but we do understand that they may change a lot over time. Based on the currently available data on December 2020, we get 114 return on Airbnb and by 30% return on both Certara and Upstart. If we multiply these return levels by the amounts that we invested in each of these 3 new IPOs, we get $243 of expected return on these 3 IPOs. Adding $82 of return on Ozone to the bucket, we get a total of $322 of return on these 3 investors. $325 on your $1,000 on the brokerage account makes it 32.5% return on the whole amount. Everything looks good so far, but let's not forget that we still have $410 sitting idle on our brokerage account. So now, let's just imagine that we focused on a new potential IPO and say it is Phoenix Tree Holdings. You do the same as always, you send an application to your broker for the full remaining $110 on your account, but this time your allocation is not reduced and you get 100% confirmation, which means that your full remaining $410 go to this last IPO. And we're so unlucky that this IPO becomes an epic failure with a total loss of 75.5% loss on your investment. And so, out of the 410 invested, we are now left with only $100. You simply lose $310 in this one trade, and all your earnings on the 4 previously successful IPOs, Ozone, Airbnb, Upstart, Certara, of $325 are wiped out almost to zero with this one loss of $310. So rounding it all up, your net income after all these deals will only be $15 to $1,000, which is 1.5 5% of annual return after all your time and efforts. You might think this is quite rare to happen. More than you think, my friends. More than you think, I'm afraid. It is precisely because of this one element of IPO deals, percentage of capital allocation, investors get used to the fact that all your requests to all IPOs are cut. So they're always cut in good IPO deals. So everyone learns to apply with as much money as only possible, since you know that all your requests will be cut anyway. But you never know upfront which deals will be successful and which ones will fail. So you end up applying with these full amounts, and at one point you're running a risk of getting 100% confirmation. And once this happens, your losses on such one deal can be devastating. So be careful and be sure to do the calculations before any of your investments are made. That's about it for now, guys. My name is Oleg Ivanov, and it's been a great pleasure to be with you on our Trendsetters episodes. Subscribe to the channel, click on the bell so you don't miss out our future episodes. And be sure to write in the comments what other trends you would like to see revealed in our channel. Have a nice week and stay safe.